I'm Brian Beaulieu, CEO and Chief Economist for ITR Economics, and thank you for joining me for this edition of FedWatch. Today is March 1st, 2023. What's caught my eye over the last week, and you may have noticed also, is how much the government bond yields have risen. The Treasury 10-year bond yield is up about 50 basis points, and the 2-year bond yield is up about 90 basis points in a very short period of time. It has narrowed the inverse yield curve, but that's not the action we want to see in terms of getting us into a normal yield curve. These higher interest rates aren't necessarily a positive sign for the economy or even beyond our economy for the larger financial picture. What seems to be going on is several large foreign players are not renewing or buying fresh bonds when their current holdings are maturing. That being China, Japan. More important than China, Japan is not doing that. Japan is the #1 holder of U.S. foreign bonds, followed by China. And Japan's holds twice as many bonds as does China. And the China bond holding is now at its lowest level in 12 years. And even the UK, the third largest bond holder, is backing off. Europe as a whole, the EU, is still holding on to their debt and renewing, flipping it over into new maturities as they come due. But really, Asia and the UK are backing off. And at first, and you're going to hear this from other people, it could be a sign that they're losing faith in the US government's ability to pay it off. And that would tie in with our Great Depression 2030 scenario. But that doesn't seem to be what's going on, which is what prompted me to look into this, because that would be an interesting tell. But that's not what's going on. Taking a look at China in particular, they're going for more return and less volatility, less risk, by going into US government agency bonds. Now, the government agency bonds aren't backed by the full faith and credit of the US government, but they're considered to be as safe as the US Treasury. There's less risk because they are shorter terms to maturity. And that means you get less volatility in the value of your portfolio. The other part of what's going on is with Japan, it became too costly for them to hold the US denominated bonds because of the exchange rate, the very strong dollar. If the dollar goes down, it'll be worthwhile for the Japanese to come back into this market. But for now, they'd rather just hold on to some Japanese bonds because they've made some financial changes within the Japanese economy. In the UK, they're just tired of losing money, I suspect, and they're going down the same path as China is at this time. Adding to the increase in interest rates is our own Federal Reserve, because they're no longer adding to their balance sheet by buying all this government debt. Historically, the Federal Reserve owned about 20%, historically being since 2008, about 20% of the foreign debt or the debt period. They're unwinding their balance sheet. So we're seeing that they are no longer active buyers. And that leads to the liquidity issue. We have the Chinese, the Japanese, the UK, and our own Federal Reserve, who's not out there buying our debt. And that's going to drive interest rates up. And even if private investors like you and me, why would we hold a 10-year government bond yield at 3.9% when we can get an additional 40 basis points by holding a 2-year bond? It doesn't make sense. So this is how the inverted yield curve can create some very specific financial disruptions. It's not the way it's normally supposed to go. We're going to watch this very, very carefully, because if the illiquidity factor continues to ramp up, then these interest rates are going to go higher and higher, and that's going to cost the government more and more money that can ill afford given the size of our national debt. Again, it's not a 2030 problem yet, because the Chinese are buying government agency bonds, but it is something to keep a very careful eye on, and we're going to do that for you. What can the Federal Reserve do about this? What we've been saying for a while, they could lower interest rates starting now, start lowering the Fed funds rate. I know their fears, we all do, because we've all read their material, but I don't think their fears are founded. We're going to see inflation come down enough, particularly in the core consumer price. It's really not the consumer price index, but the core personal consumption expenditure price index. Backs out food, backs out fuel at the filling station. doesn't back out utilities or home heating oil, but home heating oil is not the problem right now. It's more diesel and other types of energy. So they have the keys to unlock this problem. We'll see if they're going to jingle their keys and walk past the cemetery, or whether they're going to do something about this. It's up to them. You and I, all we can do is be bystanders. And the management objective of all this, illiquidity means, in the treasury market, means it will spread even more to other markets. So if you are interested in getting a loan, then do it sooner rather than later. And these interest rates, rather than coming down right now where we thought they were going to be doing, are taking the surprising rise. So expect to see a new U.S. government bond yield forecast from ITR this week. Thanks for watching this edition of FedWatch. Look forward to next time.